Hey, welcome to The Explainer. Today, we're going to crack the code on stock analysis. We're breaking down something that can feel super intimidating into something anyone can get their head around. And we'll use some amazing real-world examples from Ghana's top companies to do it. Okay, so let's just get right to it. How do you actually spot a great investment? It's the million-dollar question, right? For so many people, it's the one thing that stops them from even getting started. It just feels impossible. But here's the secret. It's not magic, and you definitely don't need to be a Wall Street wizard. What you really need is a framework, a simple toolkit you can use over and over again to check out any company. And that's exactly what we're going to build together today. So, I want you to think of this as your financial detective kit. We're going to equip you with 6 key questions, your essential tools that let you investigate a company's health, just like a detective on a case. All right, here's our checklist. First up, the basics. Is the company actually making money, and is there room for it to get bigger? Then we pop the hood and look at the engine. Is it generating real cash, and is the stock priced fairly? And finally, we look at the bigger picture. Do you trust the people in charge? And what's happening in the wider market? These 6 questions, this is our whole guide. Now, before we can really use our detective kit, we need to learn a little bit of the lingo. But don't worry, it's way simpler than it sounds. There are really just 3 key terms that unlock pretty much everything you need to know. First up, total assets. This is, just all the stuff a company owns. Simple as that. We're talking cash in the bank, the buildings it owns, the products on its shelves, all of it. Next, we have liabilities. This is pretty much the exact opposite. It's everything a company owes to other people. Think of these as its debts and all its financial promises. And our final term, equity, is where it all comes together. If you take all the stuff a company owns, its assets, and subtract everything it owes, its liabilities, what's left over? That's the equity. It's the true bottom line value that belongs to the owners. All right, detective kit? Check. Vocabulary? Check. Let's put this stuff into action with our first case study, the market leaders. These are the heavy hitters, the companies that are performing incredibly well and dominate their fields. So, in this corner, we've got the telecom giants MTN Ghana, Total Petroleum, and 2 banking powerhouses, GCB Bank and Ecobank Ghana. Let's take a look. Whoa. First, let's just look at MTN Ghana. The big story here is just how insanely profitable they are. I mean, over 5 billion Ghanaian cedis in profit after taxes, and check out that net profit margin, 28.1%. To put that in perspective, in most industries, anything over 20% is considered excellent. So yeah, they're crushing it. And this number, wow. This really shows you just how efficient MTN is. An EBITDA margin of 57.2%. Now, EBITDA is just a fancy way of looking at a company's pure operational profit. A number this high is incredible. It's the sign of a very, very well-run machine. Okay, now let's turn to the banks. We've got 2 giants here, GCB and Ecobank. I mean, both are huge, with assets over 40 billion cedis each, and both are pulling in massive profits. But the number that should really make an investor's ears perk up is this one right here, return on equity. So Ecobank's return on equity, or ROE, is a stunning 38%. So what does that even mean? It tells you how good the company is at making money with the money shareholders gave it. And let me tell you, a return this high is absolutely fantastic. It's a huge green flag for a market leader. But, investing isn't always about the obvious home runs. Sometimes you gotta pull out the magnifying glass and dig a little deeper. And that brings us to our next category, the cautious bets. These are solid companies, but their stories are a bit more complicated. For this round, we're gonna take a quick peek at SIC Insurance, Access Bank, and Digicut Advertising and see why their situations are a little more nuanced. Access Bank is a really interesting puzzle. Check this out. On one hand, the company is getting way bigger. Its assets are up by almost 35%. But at the very same time, its profit is actually down by over 13%. So what's going on here? It's a classic mixed signal. The bank's growing, but it's getting less profitable. That's a trend you'd want to investigate a lot more. And the story with SIC Insurance? This is a perfect example of why you can't just look at the top-line numbers. Just look at where all the money goes. The actual insurance part of the business is healthy, but then, whoosh, over 97% of the income gets eaten up by costs and expenses. That tiny little sliver left over, that's all that's left for the shareholders. All right, and now for our final and maybe the most dramatic category of all, The turnaround stories. These are the comeback kids, the companies that were on the ropes and fought their way back in a big way. Let's start with Cowbank. To really get the picture, you have to see where they were in 2023. A net loss of over 671 million CDs. I mean, that is a huge hole to be in. Things were looking pretty rough. But then, look what happens just 1 year later. Boom, a complete reversal. They didn't just stop losing money, they turned that massive loss into a solid profit of over 267 million. That's not just a recovery, that is an incredible turnaround story. And the story at Standard Chartered Bank is just as wild. And hey, you don't even have to take my word for it. This quote from their own report just says it all. A 457% increase in profit before tax. I mean, come on, that is the definition of a successful turnaround. So we've seen the market leaders, the cautious bets, and these amazing turnaround stories. What's the big takeaway here? What's the one thing you should remember from all this? It's this: you can do this. You don't need to be some financial wizard to understand a company's health. It's really just about having a simple framework, about asking the right questions. And now you have that toolkit. So the only question left is, what are you going to investigate next?